Hey everyone, this is Mortgage Mario. So I want to walk you through an example loan estimate and closing cost. So I kind of have this set up for a first-time home buyer putting down only 3%. So a lot of first-time home buyers just think, hey, I'm putting down 3%. That means kind of this bottom line cash to close should say 12,000. And they look at something like this and they go, oh my goodness, what is that? What does all this mean? This is kind of scary. So I'm kind of here to break this down for you just to make this seem a little bit less intimidating to walk you through this. So essentially, we can break it up section by section. So section A, those are the costs coming from the lender. So really the best way to compare closing costs from a lender would be section A. And then B, you have all these third-party fees, such as an appraisal fee. You have to get a licensed appraiser to get out to the subject property, actually find out the value of a property. That's kind of like an average cost there for an appraisal. If it's new construction, you may have an extra fee for that as well. Credit report and things of that nature. Now, if it wasn't conventional, you'd have something called FHA upfront mortgage insurance premium. If it was FHA, that's about 1.75% of the loan amount that gets typically financed into the loan amount, or the VA or USDA. So anything that's government backed, essentially. They're more lenient in certain regards like credit, but they do have that upfront mortgage insurance premium depending on which loan product that is. So also, you're going to have a licensed attorney that's going to close on the mortgage. So essentially, they'll have their settlement closing fee, other fees such as exam fee, binder fee, something called premium for lender's coverage. So that's an insurance policy that the attorney actually sells to the buyer in the event that if they miss something on title search, that the lender wouldn't be held accountable for paying for that. And so they also sell another policy um, called owner's title policy, which you're going to find in section H right here, which is similar, but it's for the owner, it's for the buyer. So that's actually optional. The government does not actually mandate for the owner to pay for that. But if the title or the closing attorney were to miss something on title search and you were to get title and there was a lien on the property, or mechanics lien is a very common reason, then in that case, you could be held accountable for paying off that lien. So that's for a $400,000 house, that's kind of like an estimate there of what a closing attorney would charge for that. So it seems like kind of too much risk, not enough reward if you were to waive that fee, in my personal opinion. Um, so what we see here in section D is kind of total loan costs. So these are the costs to get the loan. You can tell kind of the majority don't really come from the lender. And also to get back to section A, some lenders charge origination. And actually you can pay discount points to buy down the interest rate. So if you wanted a lower interest rate, you could actually pay discount points to buy that down, depending on how long you're going to live in the property. And things like, hey, is there going to be a future refinance down the road? Maybe rates will drop in the future. I'm going to refinance. So it may or may not be a good idea to buy down a rate, just kind of depending on what the market's going to do and how long you're going to live in the property. Obviously, if you're going to live in the property for 30 years and rates are never going to get any lower from where you're speculating at the time with interest rate, then you may be better off buying down the rate as low as possible. So again, a loan officer can kind of analyze that. So um, now to get kind of to the other side, you will have things like taxes. Yeah, I'm using Georgia because I'm originating a lot of mortgages in Georgia, from Georgia. So things like taxes, and then you have things like prepaids, which aren't really necessarily a true cost per se, but essentially you'll pay up front for an entire year of homeowners insurance. So if you were to close on this, in May of 2023, that you'll actually be paid for up a year up front of prepaid homeowners insurance. Another thing called prepaid interest. So prepaid interest is essentially kind of the time where your mortgage is in mortgage limbo. People think that when they get a mortgage, sometimes they're off the hook for paying for a month or so, especially on refinances. But essentially, if you're to close in the middle of May, you'd have kind of 15 days until your mortgage starts. Your mortgage would start, June. and you always pay for a month of behind. So your first mortgage payment, if you close in the middle of May, actually wouldn't be until July 1st, and you pay for June, always a month behind. In that period of time where you lived in the property and you actually weren't paying a mortgage, that at the closing table that they're going to collect kind of that daily interest, and so that's going to kind of depend on your loan amount, and also your interest rate is going to affect that, and then the amount of days that you're living in the property without actually having a mortgage. So this could change. It could be anywhere from 1 to 31 days essentially. So it's towards the end of the month, it would be a lower number. Towards the beginning of the month, it would be a higher number. So not necessarily a true cost. That's where a lot of lenders will just kind of, when they show estimates, they'll waive this essentially, when they initially show quotes, because they know it really doesn't come from them. It really just depends in the beginning, but it can be kind of misleading when a lender doesn't really walk through things like prepaids. And then also, to my next point, escrow. So essentially, if you're doing a conventional loan and you're not a first time home buyer, a lot of times you actually have the option of waive escrow. Typically, first time home buyers, or if you're putting down a very small amount, maybe around 3%, things like that. Sometimes you may have to escrow, but essentially, escrow is a savings account to automate taxes and insurance. So again, not really a true cost. And this number completely depends as well, and so it really actually doesn't come from the lender whatsoever. But again, a good loan officer is going to really kind of walk you through what this means, and also, how this number could change depending on the property you're buying, depending on the homeowner's insurance, depending on the county the property's in, depending on when you close on the property. So, for example, a lot of times they'll just want to have a little bit extra go into, and it's basically like a savings account for taxes and insurance. So just they always want a little bit of a cushion there. So when you pay your mortgage, say you close on this in the middle of April and you get your first mortgage statement July 1st, you'll see something called escrow. And so you'll see that all these funds in an escrow account. So you can only tap into that once you either refinance or sell the property, and the loan service will write you a check. But basically, they want to make sure you have a little bit of money saved up as a rainy day policy in the event that, hey, what if your homeowner's, like, the lender is in control, the loan servicer doesn't control homeowner's insurance? What if you're with, some insurance company, and your insurance goes up for whatever reason, you make a claim on the roof, and it goes up, or something else causes it to go up. So they want to make sure they have kind of a cushion when they're automating that payment, that they have a little bit of reserves there. Kind of same thing with the county. So depending on when you close, is going to be kind of depending on how much escrow cushion. But just take note that, if this was, say, $2,000 higher, it's not like it's really like money out of your wallet. It's really just to kind of help automate some things. And at the end of the day, you're going to pay whatever you in a year, whatever you owe to the homeowner's insurance company. That's what you're going to pay. And same thing with the county when the loan servicer picks up the check from the tax assessor. Typically during the end of the year with most counties, they're going to pay whatever the tax assessor tells them what's due, and whatever differentials left in the escrow account, that's going to stay in there just like a savings account. That's not a cost. So that's probably one of the more confusing things when it comes to breaking down closing costs. So again, that would just, when you're kind of looking at a ballpark estimate, you don't have a property or anything like that, just kind of take note that that definitely can change. And that's just going to depend on again, homeowners insurance and the county. And you could have city as well. So that could, depending on if you're in an area where it's got city tax, that could be in there. Um, and then we did discuss title, owner's policy, and then what is this HOA initiation? So if you do join like an association, an HOA, or a condo complex that's got an association, a lot of times they make you, it's kind of like joining a country club, that they make you actually pay like an initiation fee to be able to join there. So that would be on your final closing disclosure. It should be in the contract when you have a binding purchase and sell agreement. And the loan officer should put that in there, whatever is on the contract. So again, that's kind of a third party fee there. So that could just depend, obviously, on the property. So basically, this is kind of how you would break it down on a loan estimate, where you kind of see the other costs. Those are kind of the prepaids, escrows, taxes, things like that, and initiation fees. And then obviously this is kind of section D is your total loan costs, and then And if you want to look at, hey, what actually are the total closing costs in this scenario? Well, in this case, it's almost about $13,000, just as a complete example. So, although that you did have a 3% down payment, that goes straight into the equity of the property. That's not a cost as well. That will reduce obviously your loan amount. Since it's a $400,000 property, put down 3%. That's good. You've got some ownership in the property. It's good to put a little skin in the game buying a house. And so that's not really a true cost, but you will have some fees on here to be able to that's a one-time fee essentially to get in the house that you'll have to pay to be able to make kind of the accounting equation work and to pay all the other real estate professionals to properly conduct their job to close on this transaction. So essentially, um, what you see here is some other things in a transaction. I left out here so it wouldn't be misleading on your bottom dollar, but essentially on a loan estimate and closing disclosure, you'll put down an earnest money deposit, and that's up to what the realtors negotiate and what the buying real estate agent puts on the offer when making an offer on a property. But as a rule of thumb, is basically it's usually 1% of the purchase price. So you'll put down a 1% earnest money deposit. Look at it as like a deposit, just out of good faith. Like, hey, I'm gonna get an inspection on the property. I'm gonna do my due diligence, but I really mean business. I really want to buy this house. And here's my deposit. And so that can be misleading because if I were to put that there, that would make your cash to close look $4,000 cheaper. So essentially kind of left that out. Also, at any point before you make an offer, or even during the due diligence, when you get an inspection on the property, something pops up especially during inspection, like, hey, the roof's bad. We need a new roof and it's going to cost $7,000. Well, that can be negotiated. So you can get the seller to pay $7,000, or you can even when making an offer, you can even make an offer and just say, hey, I want the seller to pay for $10,000 of closing costs. So depending on the loan product and depending on your loan to value, what determines loan to value is the down payment. So basically, you just take the down payment and subtract by 100. So if you put down 3%, your loan to value is going to be 97%, for example. So kind of depending what bracket you put in the loan product, you can only put down so much seller's concessions get so many seller's concessions, I should say, or seller paid closing costs is what those are in layman's terms. And I believe in this scenario would be about 3%. So the maximum the seller could pay in that scenario would be $12,000 for seller paid closing costs. So that would obviously basically cover most of the closing costs, and then you're getting into a house with just a down payment, which goes towards the equity of the property. And then you're going to have seller proration. And so again, title, when they bounce the final closing disclosure, the closing attorneys, on the final closing disclosure that you sign on, which isn't the same as a loan estimate. A loan estimate is a good faith estimate from the lender, forecasting all their fees and then also all the third party fees in the transaction that we just explained. But when the title basically does title search and everything, so they will do something called seller's proration for taxes, and then you can have that on county and that on city. And basically, if like I use Cobb County in Georgia, for example, taxes are due in October, I believe. If you move in and you close on this in May, so let's say you close this in May, so the seller lived there for 4 months. So if the seller lived in the property for 4 months and you're going to pay property taxes in October of 2023, well, it wouldn't be fair that you're paying an entire year of property taxes, but you didn't live there for an entire year and the seller lived there. So the seller, it's kind of an accounting equation, and the seller will actually pay you kind of their fair share to make that work. And so they would multiply that by 4 months, and if you moved in halfway, it would be more of May. It would be 4.5. It's kind of what they would multiply that by, and that's how much the seller would actually give you back towards closing in that scenario. So that again, your closing cost is going to be dictated by when you move in and when the county collects property taxes. So obviously, when you're talking to a loan officer and I want to you put a gun to their head and you want an on the penny exact estimate. I hope you can kind of understand how that's very difficult and challenging, to be able for a loan officer to be able to come up with a very transparent quote. Really, a loan officer, their job is to be conservative. So, if they want to tell you a certain dollar amount, they really should kind of be overshooting some of these third party fees, or at least kind of be around market averages. Just so when you do get when the closing attorney balances the final closing disclosure, and you see what your final cash to close is when every firm number is entered in, well, that way it's not undershot. You always want to overshot in a pre-approval type of a status when you don't have a property, or else you'll be kind of saying dirty four-letter words to the loan officer if you're short by you end up having to pay $5,000 more at the closing table. So you always want to maybe slightly overshot. So that's basically a fair breakdown. Remember, if you're going USDA, just certain geographical eligible areas, it could be zero down, but you would get hit with that USDA funding fee that would be financed into the loan amount. VA is awesome. No private mortgage insurance on VA, so we can go zero down, no PMI, which is phenomenal. And then on conventional, you are going to have something called private mortgage insurance. When you put down less than 20%, you have private mortgage insurance. So in this case, it's about 11640. So things like credit score, first time home buyer status, debt to income ratio, things like that, and then loan amount and things of that nature can all affect PMI. So just remember that's kind of an estimate as well. But yeah, I hope this helps, and have a wonderful day.